After a big year of gains for the major stock indices, stocks have been under pressure a little bit in the first few days of 25. While it's hard to imagine a third year of similar gains, our next guest says the bull market is intact, even with the U.S. Federal Reserve having some trepidation about steeper rate cuts. Baird investment strategy analyst Ross Mayfield is here. He says there are still investable ideas in areas such as large cyclical sectors and elsewhere. Nice to see you, Ross. Thanks for joining us.
Thanks for having me.
I understand you don't quite understand the Fed's trepidation to cut rates more, or at least to open the door for that. And you also point out that a lot of this has to do with owner's equivalent rent. And if you strip that out, CPI is actually around 2%. So can you elaborate on your thinking here?
Yeah, absolutely. So we have the labor market cooling. We see that with a variety of indicators. We have inflation down around 3% by a variety of metrics. As you mentioned, the big thing keeping inflation elevated, and particularly core inflation, which the Fed likes to look at, is owner's equivalent rent, which is a metric that isn't really experienced in the real economy, right? It's trying to get to a housing measure, but if you look at something like Apartment List or Zillow at what asking rents actually are, they're down year over year, they're negative. So if you kind of just swapped out that lagging indicator, you'd have inflation of 1.5% to 2%. And the Fed would look far too restrictive, in my opinion, and all the trepidation about at least cutting rates to neutral, which they view as something around 3%. I think they would be able to do that with a little bit more haste. I think they're potentially risking, this nice economic recovery and soft landing because they're a little nervous about inflation that might not yet materialize.
It also seems that the Fed is trepidatious about the incoming Trump administration. And as you note, they are incorporating into their calculus changes in immigration, changes in tariffs. And you think this is a misguided approach. Why?
Well, for number one, the Fed says they are they want to be data-driven organization, right? So they're incorporating potential policy outcomes that have not yet happened, right? That's not data on the ground. That's not looking at prices or the labor market. That's potential for policy that may happen, may not happen. If the tariffs and immigration were taken to the extremes that were promised on the campaign trail, those would likely be inflationary. But I think if you just have to look back to 2017, 2018, and 2019, right? Before COVID, but when Trump was in office the first time, immigration and tariffs were two of his big platforms then as well. And inflation was basically 2% for those 3 years. So I think that trying to front run a policy proposal that we know is at least in part negotiating tactic and might be watered down by tight margins in the House and Senate, I think it's misguided. There are reasons that inflation might crop back up, but I also think that we have to look at some of the signs in the labor market and say, all right, we don't want to risk what is essentially the entire U.S. economy, which is the labor and the consumer.
Now, Ross, as you know, there are many who think that further gains for stocks this year will be much more difficult after 2 big years. But you say the bull market's still intact. There's room to run here. What's your reasoning?
Yeah, well, let's start with history, right? So going back to 1930-ish, Great Depression, you have a handful of bull markets over that, roughly 90 to 100 years. The average bull market is 60 months and about 180% for U.S. stocks. Today, we're sitting at 27 months from the October 2022 lows and about 70% off those lows. So again, as you mentioned, a great 2 years. But as far as bull markets go, still well short of the average bull market by both length and magnitude. So just to get to average, you have room to run. Are valuations extended? Do we expect multiples to expand from here? Maybe not, but earnings can pick up the slack here. We expect, analysts expect earnings to grow 10 to 15% this year. Mag 7 growth of 20+%. So earnings can kind of take the baton from valuation expansion. You still have the Fed cutting rates. You still have a solid enough labor market and consumer. And you have the specter of corporate tax cuts and deregulation that, kind of boost animal spirits at U.S. companies. So I think there's plenty to still be excited about, even if there's a lot of uncertainty on the horizon. And then again, just looking to the math, there's room to run just to get to what an average bull market looks like. You still have cyclical leadership. You still have tight credit spreads. You have a lot of the things that would say fundamentally the U.S. economy and market are on solid footing.
You mentioned tight credit spreads. Let's get to that. They're tight, even high yield yields compared to government bond yields. But then you've got there is the risk of the 10-year in the U.S. heading towards 5. Is that sort of a bugaboo level, so to speak, in terms of the stocks maybe rolling over and investors getting spooked if it keeps going up?
Yeah, I think that's right. I think it's the most obvious near-term risk to a market that heading into December was stretched by valuation and sentiment. Quite frankly, the 4 or 5 level has been an area of concern. Our partners at Strategist, a Baird company, had identified that level as opposed to 4.75 or 5. So we're already through the kind of first guardrail that would signal investor angst, and we're seeing that in the markets. There's clearly a discomfort with the 10-year that high, and I think more so, the idea that, all right, we all had anticipated that as the Fed started cutting rates, we get the lower yields across the curve, and that would unlock, mortgage borrowing or corporate borrowing, corporate investment. And instead, as soon as the Fed cuts rates, the 10-year takes off up and to the right. We're now pressing towards 5%. So the question I think that investors are asking is not necessarily, can the economy operate well at 4.5, 4.75? It can. But where does this end? And if it's being driven by deficit or fiscal concerns, and we have a multi-trillion-dollar tax cut coming down the pipe, are 5-6% on the 10-year on the horizon, and what would that mean for equities? And I think that might be a little bit more ominous in what stocks are reflecting today.
As far as overall strategy, Ross, you mentioned the Mag 7. You like cyclicals. You like AI-related companies as well. So you're saying investors should lean into high-quality, large U.S. companies with cash flow. Can you elaborate on that for us?
Yeah, absolutely. So on large over small, to me, it's entirely a rate story. U.S. large caps have much more capital to deploy. They're much less sensitive to interest rates. Small caps are rate sensitive. They have more floating rate debt. So when rates go up, they feel it even more. So I like large over small. We also have potentially a deregulatory and M&A kind of animal spirits coming back. So could benefit large cap companies as well. More tech, more growth in large caps. So generally large over small. I think U.S. over international, simply because of the dollar story. I think it's going to be very difficult to get much weakening out of the dollar this year, given some of the policy prescriptions. So U.S., we already know the economic and interest rate story there. And then finally, as far as quality versus, junkier stocks or bonds, defensive stocks, the sectors that are typically defensive have not worked so well, primarily because the reason for equity market weakness is higher rates. And so those yield proxies with high dividend yields like staples and utilities sell off when rates rise. So where do you go for protection? I think you go to high quality names that can generate their own free cash flow, names with wide moats and different businesses. The Mag 7 to me falls into that category. And they can really bring their own growth to the table if the U.S. economy falters in 2025. So I think those would be kind of the three legs of the stool that we're sitting on at the beginning of the year here.